Good morning again to those I haven't greeted yet. Thanks, Mrs. Moore. I knew you would know that song. It played in the movie theaters when we were young. Right, ladies and gentlemen, we are trying to finish with question 3. It's been taking us a while. The reason for that is we've really tried to or attempted to cover all possibilities, not only the possibilities in that particular question. As you know, we've looked at situations such as dividends received, which is related to dividend income, even though it doesn't appear in this question. So we really try to make it as comprehensive as possible to cover all possibilities. So, okay, so let's just recap where we are. So at the moment, we have completed the note to the statement of cash flows. We've completed the operating activities section as such. So we completed the operations part. We completed the other 5 possibilities there. Then we had a look at the investing activities. We also looked at it in our very first class. So we reconstructed some of those accounts in the first class on this question, and the remainder on this during the second class of this particular question. So what is left for us, ladies and gents, are the following 2 areas. First of all, the financing activities. So we've still got to look at the financing activities, and then this little section at the end where we have to reconcile our cash and cash equivalents at the beginning of the year with the cash and cash equivalents at the end of the year. And during that process, we also determine whether there was a net increase or a net decrease in our cash and cash equivalents during the year. Okay, so let us start with the financing activities, ladies and gentlemen. You know, sometimes I'm like a little child. I like things that rhyme. So I'm going to give you a little rhyme here. What do financing activities deal with? What do financing activities cover, ladies and gentlemen? In a nutshell, if you want to use a short little phrase, it deals with own capital and loan capital. So if you want to make a little note there, own capital and loan capital. So, ladies and gentlemen, when it comes to a company, and it is time to warm up our fingers to type a few things for us there in the chat box. When it comes to a company, what would represent own capital? What would be, what kind of instruments would represent your own capital, own capital? If you can type for me there, please. Someone wants to venture a guess. Come on, says Mrs. Moore, and I agree. Come on, someone's got to type for me. What represents own capital in the case of a company? What do we call that kind of capital? We've got 2 classes of them. There, I give you a further hint. There are 2 classes of them. And if you want another hint, we did it earlier in the year. One of our topics, one of our major topics. There, Mrs. Moore gives you a perfect clue. Where does the capital for a company primarily come from? Oh, looks like we'll have to help them out here. It is your share capital, right? So the own capital in the case of a company is represented by the share capital, and we know we've got 2 classes of shares, namely ordinary share capital and preference share capital. So we'll have to go and have a look whether there was any inflows or outflows with regards to own capital, which is our share capital. What is the other kind of capital? Generally speaking, loan capital, ladies and gentlemen. So what would loan capital represent? That is capital or financing that we get for our company, but it does not come from our shareholders. It comes from third parties, but not the shareholders. So there we would be looking for things like, for instance, long-term loans or even short-term loans, debt instruments that you know about, like we had it beginning of the year that we call debentures. There's another kind of debt instrument called bonds. So loan capital, any borrowings by the company or any loan instruments that the company has issued. Right, ladies and gentlemen, so we know that the financing activities deal with own capital and loan capital. Then we can also go and subcategorize that. We can say there can only be one of two kinds of possibilities. There might be 3 or 4 or 5 lines where we describe the inflow or the outflow of cash, but there can only be 2 types of inflows or outflows here. In the case of our own capital, in other words, the ordinary or the preference shares, it can only be, in the case of ordinary shares, a share buyback that would represent an outflow or cash. Or in the case of an inflow of cash, it can only be the proceeds from the issue of shares, right? In the case of preference shares, it can also be the proceeds on the issue of preference shares. And then what do we use the term? What word do we use if we have a so-called buyback of preference shares? Then we do not call it a buyback. What do we call it then? If somebody can type that for me. We call that a what of preference shares if we buy them back from the preference shareholders. Starts with an R. R. What do we call it then? Even though it's not in this question, like we said, we try and cover all the possibilities. Who wants to type something for us? What do we call that, ladies and gentlemen? A redemption. A redemption. Thank you, Mrs. Moore. So then it would have been a redemption of preference shares. In the case of loan capital, ladies and gentlemen, also there can only be one of 2 possibilities. Either an outflow of cash if you are going to make some repayments on a short-term loan or a long-term loan, or again, when you are redeeming any of the debentures. And the inflows would be if you acquire a new loan, a new long-term loan, or a new short-term loan, or you issue further debentures or further bonds, right? So those are the ones that we have to go and investigate. Now, ladies and gentlemen, since your fingers are still pretty not used so far, let's type in something for me. Where will be a good place to start? Which statement would be a good place to start if we want to go and determine whether any possible shares have been issued during the course of the year, or whether any ordinary shares had been bought back, or whether any preference shares had been redeemed? Which statement would be a good place to start searching for it? If you can type for me there, even if you use the abbreviation, which statement? Which statement, ladies and gents? Looks like all of your keyboards have suddenly stopped working. Where will you find changes in equity? There, I've given you the answer. So a good place to go and search for that. Thank you, Lihle. Thank you. There you go. The statement of changes in equity. Right, there we go. So let's go to our statement of changes in equity. If we were not presented with a statement of changes in equity, then we would have had to look at the additional information. But in this particular question, I'm just saying that because you may find sometimes that you are presented with this information in the additional information instead of a statement of changes in equity. But in practice, like we said last week, in practice, you would have completed the other financial statements first before you even start drawing up the statement of cash flow, simply because you can get all the information to draw up the statement of cash flows from your other financial statements. So there we see we are presented with a statement of changes in equity. So now it is pretty easy for us to see, if we look at the various columns that represent our categories of equity. There we can see in the case of ordinary share capital, we started with a balance of 925,922. We see there were no ordinary shares issued. There were no ordinary shares bought back either, and our closing balance is exactly the same. So in this particular question, no ordinary shares were issued and no ordinary shares were bought back either. But we must still go and make sure, ladies and gents, we could also have had a look. The second way that you can have a look at this, which is not necessarily the full information, is to go and have a look at your liabilities, but there we can see there are changes, right? So the only way that we can go and determine what those changes were would be to go and have a look at our statement of changes in equity, right? So in the case of ordinary share capital, we see there was no inflow of cash, no outflow of cash, simply because no shares were issued and no shares were bought back either. So let's go to our other class of share capital, namely preference share capital. So let's see what the situation is here. Here we can see at the beginning of the year, no preference shares were in issue at all. We started the year with a zero balance. The second line simply transferred the total comprehensive income over from that statement to this one. And then here, ladies and gents, we can see there it is described as preference shares issued. Preference shares issued, 137,500. So let's maybe just ask one question there, and now you can answer for me, please. Shares issued, would that represent an inflow of cash or an outflow of cash? If you issue shares, what do you get in return? Except in the case of a capitalization issue, which we know is a little bit of a exception to the rule. Thank you, Leslie, again. Right, so it'll represent an inflow of cash. But in that same statement of changes in equity, we also see that we incurred certain share issue cost, right? So that would normally be a commission that you pay to the financial institution that manages the share issue on your behalf. So that has been set off against our preference share capital. So that little one, would that represent an inflow or an outflow if you have share issue cost that was set off? Inflow or outflow? That would be an outflow. Thank you, Leslie, again. Right, so ladies and gents, the practice is that we do not show them separately on the face of our statement of cash flows. Why not? Because they have already been separately disclosed here in our statement of changes in equity. And as we've said on a few occasions earlier in the year, we never duplicate information in our financial statements. We never repeat information that we have already provided. We always provide new information. So now we do not want to show the value of the shares issued. We do not want to show share issue cost set off. We simply want to show what was the net effect on our cash flows, right? So that means it will be the proceeds on the issue of preference shares. That will be our description. And clearly we're going to show the net amount there. So let us go and have a look at our, oops, sorry, there I just accidentally unshared that. Let me just see whether I've shared it again. Yes. So let's go to our statement of cash flows. And there we've got exactly that description. Proceeds from issue of preference shares. That was the gross amount that we have raised through the issue. That was the share issue cost that we incurred in the process of issuing those shares. So the net inflow of cash, and remember we said when we indicate inflows, we are going to indicate them as positives. So the net inflow of cash is therefore 136,350. Ladies and gents, alternatively, like I say, if they had not presented you with a statement of changes in equity, then you would have had to look at the additional information that they've provided. So let us go and have a look at it in any case. You remember when we started this question, when we read through the additional information, we marked certain items with I's and certain items with O's and certain items with F's. And the two that we marked with an I was the first paragraph, you remember, and then the last paragraph, not an I mean an F, sorry, an F, financing activities, and then the fourth paragraph as well. So we must still go and look at that one. Alternatively, you could have also calculated this, ladies and gentlemen. So if you have calculators handy, I have actually checked this one beforehand. They say on the 31st of May 2020, 250,000 preference shares were issued at 55 cents per share. And then they also say share issue expenses of 1,150 rands were paid. We could also have seen that on the face of our statement of changes in equity. So I'm just saying that if we were not presented coincidence in this question with that statement, we could also have found it here in the additional information. So if you take 250,000 and you multiply it by 0.55, in other words 55 cents, you'll see you also arrive at 137,500, right? Okay, so now we had a look at inflows and possible outflows with regards to own capital. Now we've still got to look at possible inflows and outflows with regards to loan capital, ladies and gentlemen. So where would we find our loan capital? There are only two areas on our financial statements that deal with loan capital, and they are our non-current liabilities and our current liabilities, right? So we'll have to go and have a look at our statement of financial position. So let's scroll up. There we see we've got non-current liabilities and we've got current liabilities. So let's maybe start with the non-current liabilities. In the case of the non-current liabilities, we see that it started the year with a balance of 312,500. And they also tell us this is a mortgage loan. Now, what is a mortgage loan? Let's maybe just briefly mention that. That is a loan. So it is a long-term loan that you've acquired from a financial institution, such as a bank, for instance, right? But it is directly linked to a piece of property. A mortgage loan is linked to a piece of property. So if you have purchased land, for instance, then you take out a mortgage loan, and that land is then the security for that financial institution that grants you the loan. So if you default on your payment, if you do not make repayments on your mortgage bond loan, they are then what do they call it? A secured creditor. A secured creditor, so they can get a notice of attachment from the court. It's a long legal process, but they can get a notice of attachment from the court, and then the messenger of the court can then sell that piece of land, let's say at an auction, in order to repay the financial institution. Okay, the fact remains it is a long-term loan. It's just a specific kind of long-term loan. So we see it started with a balance of 312,500, ended with a balance of 125,000. Let us just see if they mention anything in the additional information with regards to that mortgage loan, ladies and gents. And remember, we only have to look at the paragraphs that we've marked with an F. That one we've already covered. So that was the only other paragraph. But that one deals with a short-term loan. So we'll have to address that separately. So we've got no further information regarding the mortgage bond loan. Right. So that is the only information we have. The fact that there is a decrease from the beginning of the year to the end of the year. Now, ladies and gents, type for me, please, in the chat box, if a mortgage loan decreased, clearly decreased from 300,000 to 100,000, right? If a mortgage loan had decreased from the beginning to the end of the year, did you take out a new loan or did you repay on the loan? You can just type for me new or repay on the loan. If it decreased, repaid. Thank you, Litle. You owe less at the end of the year, so you have made some repayments. So now it is just a matter of taking your calculator and calculating how much capital did you repay during the course of this year. So that will simply be that 312,500 less the 125,000 rands, right? And then we've just got to go and describe it appropriately on our statement of cash flow. So there we have it. Proper description: repayments on mortgage loan. I don't want to split hairs here, but there's a reason why we're not saying repayment of mortgage loan, because there is still a balance at the end of the year. So we haven't completely repaid it, but we've made some repayments on the mortgage loan. And what is the amount? It's the difference between the opening and the closing balance, 187,500. And clearly, ladies and gentlemen, that will be an outflow of cash because you have made repayments. Again, like we said last week and the week before, if you want to determine whether it's an inflow or an outflow, you can simply look at the description. The description reads repayments, or you would have described it as repayments. That clearly indicates an outflow of cash. Or you could have gone and you could have reconstructed that mortgage loan account if you wish, and then you would have seen your bank would have been credited and the mortgage loan account would have been debited, because it started with an opening balance, which is a credit, but the closing balance is much less. So it means you would have credited your bank account, right? So now the only other item that we still have to go and have a look at, there I've gone and done it again, is to have a look at our current liability. So we go back to our statement of financial position. Accounts payable, we know that dealt with the operations. That has to do with our dealings with our suppliers and employees. Current tax payable, we've covered. That has a link to the cash flow we call income tax paid. Shareholders, we've already looked at. That was part of the cash flow that we refer to as dividends paid, also under our other operating activities. So this one we haven't addressed yet, right? So that is clearly a financing activity. It is a loan, so it is part of the loan capital. So we see that we started the year with a zero balance and we ended the year with 50,000 rands. And we also now remember that they mentioned here in paragraph 4 of the additional information that a short-term loan of 50,000 rands was raised during the year, and that is exactly the increase from the beginning of the year to the end of the year, from 0 to 50. So there were no repayments on that loan yet. It was only the amount that we have taken out. So that, ladies and gents, would that represent an inflow or an outflow of cash? If your loan started with a small amount, or zero in this case, and it ends with a larger amount, an inflow or outflow? You can type for me, please. Inflow. Thank you, Raquena. There you go. So you have obtained a new loan. So you owe some financial institution money for that loan. Hopefully not a loan shark, but the honest to goodness bank or something. And clearly they've provided you with money. So now it's just a question of going to describe it appropriately on the face of our statement of cash flow. So what would that be? Proceeds, ladies and gentlemen, because it's an inflow. Proceeds from short-term loan raised, and we've already seen that is an amount of 50,000 rands, and because it's an inflow, we are going to show it as a positive. Right, now we've completed the three main sections of this statement, so all that is left is this reconciliation. Now, for some reason, very often, I'm not sure why, some students end this statement with net increase in cash and cash equivalents. Ladies and gentlemen, no. The next thing that you describe, not the last thing, the first thing under this very last section is your net increase or your net decrease. If that is a negative, you're going to describe this as a net decrease in cash and cash equivalents, right? If that is a positive, like it is in this case, then you'll describe it as a net increase. And once you've described that, then, ladies and gentlemen, then you are going to do next your cash and cash equivalents at the beginning of the year, which you will then add if it's a positive, or deduct if it's a negative, and your final description there is the cash and cash equivalents at the end of the year. Do not show this one at the end, right? Show that before you do the reconciliation, please. Now, just a little hint here. Mr. Gorman a few weeks ago gave you this same hint, ladies and gentlemen. There really is no excuse for you to lose this half mark, that half mark, that half mark, this half mark, or this full mark, and sometimes there's even a mark allocated to that figure. There is really no excuse for losing those marks. Why am I saying that? Because when it comes to the descriptions, you're always going to describe it like this. The only difference is that if that is a negative, if that total is a negative, the only thing is then you're going to describe that as a decrease. So you simply got to know what to do here. When you do this reconciliation, you start with net increase or decrease in cash and cash equivalents. Your next description is cash and cash equivalents at the beginning of the year. Do not call it bank account, ladies and gentlemen. There's a good reason for it. IAS 7 specifically talks about cash and cash equivalents. I'm going to talk about that just a little bit now again. And your final description is cash and cash equivalents at the end of the year. What Mr. Borman also said a few weeks ago, ladies and gentlemen, there's no excuse in losing these marks. Why? Because that figure, before you even add this up, before you do the reconciliation, that figure you can worry about just now, but those two figures, that one, the cash and cash equivalents at the beginning of the year and the cash and cash equivalents at the end of the year, they both come directly from your statement of financial position, right? So don't go and add it up first. First, go and get those two figures, the cash and cash equivalents at the beginning and the cash and cash equivalents at the end of the year. And then you can worry whether it's going to add up correctly. Right, ladies and gents? So where are we going to find the cash and cash equivalents at the beginning of the year? Let's start with a statement. If you can type for me there, which statement are you going to find that in? You can use the abbreviations here as long as you don't use it in your exams or in real financial statements. Which statement? Statement, where are we going to find assets and liabilities? Come on. Thank you, Mrs. Moore. Statement of financial position. Thank you, Rakwena. Thank you, Sipukazi. Thank you, Leslie. Oh, everybody's now awake at last. Okay, they've had their coffee now. Thank you, Leslie, again. Right, ladies and gentlemen, so that's where we're going to find it. And the balance at the beginning of the year is simply going to be in our prior year column. So if we go to our statement of financial position, we see there we've got a figure back, 42,150. Now, why I'm saying that I'm going to just talk a little bit about this again, ladies and gents. We must remember the description is cash and cash equivalents. And the bank account is a cash equivalent, right? It's a cash equivalent. So if, like I said earlier, we're just covering all possibilities. So if you had, for instance, petty cash, some cash balance there besides your bank account, you would have had to add the two together, right? So you'll add the two together, the cash, the petty cash, or what kind of cash you've got on hand, plus your bank accounts. If it's a positive, you'll add them together, and that will give you your cash and cash equivalents at the beginning of the year, that 42,150, right? So that's a freebie. That's a freebie. That's a gift. You get that straight from the statement of financial position. And the same with your closing, the cash and cash equivalents at the end of the year. So let's go and have a look at that. If we look at our statement of financial position, there we go. Again, if there had been cash as well as a bank account, in other words, cash and a cash equivalent or two, then you had to add those figures together, but you will still find them on the face of the statement of financial position. So 111,991. 111,991, there we go. Just a little word of warning, ladies and gentlemen. when it comes to the statement of cash flows, do not only look under current assets. You may find that in some years or in some questions, for academic purposes, some questions in real life, in some years, the company may have had bank overdraft. So if the company had a bank overdraft, it is still part of cash and cash equivalents, but then you will find it under the current liabilities, not the current assets. So you have to look under current liabilities as well as current assets. And in the case where the company had a bank overdraft at the beginning of the year, that figure would have been shown as a negative, right? If it's a bank overdraft, you show that cash and cash equivalents as a negative. If the company had a bank overdraft at the end of the year, then that figure would be shown as a negative, right? Okay, so once we've determined those two figures, the beginning and end of the year cash and cash equivalents, then we can go back. We take that figure at the end of the year, less the figure at the beginning of the year. That will then give us the net increase or decrease in cash and cash equivalents, right? So those marks are freebies, they are giveaways, no excuse for losing any of them. And now, at the end, now you can worry a little bit if you need to see whether it actually balances. So what we are now going to do, we're going to take the positives with regards to the subtotals of each of the three sections. So in the case of the overall operating activities, that 84,766. In the case of the investing activities, it was actually a net cash outflow. So we'll deduct the 13,775 rands. And in the case of the financing activities, we see that was actually also a net cash outflow because it's a negative. And then if we add all the positives together with regards to the subtotals and we deduct all the negatives, that must then also give us that figure, right? So first establish that figure by just deducting your opening with your closing balances with regards to cash and cash equivalents, and then add them up. And if they balance, hooray, hooray, then you're happy, right? Then you're happy and you can carry on with the next question. Or if this is the last one, you can go and celebrate the fact that you are done with the paper, right? If it doesn't work out, ladies and gents, and you've still got other questions to do, the best advice I can give you is rather go and carry on with your other questions. And if you've got time left, once you're done with the paper, with all the other questions, then you can always come back and look for a possible error somewhere during the course of your workings. I've actually learned this the hard way. I was one of those people who spent 10 or 15 minutes, or I should say wasted 10 or 15 minutes trying to find the error, and at the end of the day I never, or very rarely, could finish the paper. So that is something I learned the hard way. Okay, that is all from my side, ladies and gentlemen. Finally, we've managed to complete question 3. So the only thing that's left is just to ask you, have you got any questions on question 3? You can either unmute your microphone and ask it in person, or you can type it in the chat box there. Any questions? No questions. Okay, then we are done with question 3. Like we said, finally, I'm just going to stop this recording because the next section, the next segment of this class is going to cover a completely new question. I think Mr. Borman is doing